I'm still going through a due diligence for a training business, and that has been extensive. And so this training business was not ready for this. When these buyers approached them, they were not ready, and the owner is definitely not from a financial background, and so it's created him a lot of stress. And even my involvement, I've been very proactive with him and been on the phone with him a lot, and we've had a bit of a lull in proceedings the last couple of weeks. But even with all my advice and all my discussions with him, there's still things, because you're going from like running as a sole trader, with an individual ABN, to now he's got all this structuring in place, and business structuring and tax structuring, and talk of listing on stock exchanges and things like this. It's just a world that he has not come across, and so it's so important when you are in a due diligence process to have the right advice. So having the right advisors, and everything in this world is related to trust. So you've got to get the correct trusted advisors, and like everything, it's developing a relationship. And you've obviously, most of you have been through audits. Going through a due diligence process is another level altogether. So going through a due diligence process, you're going to be asked for, you don't know, it's random. So whatever they're looking at your financials. They'll be asking for random receipts that happened 5 or 6 years ago. They'll be asking how you calculate your revenue. Are you calculating your revenue correctly? We don't think you're calculating your revenue correctly. Why don't you have that in your accounts this year? So the questions will never stop coming. And one of the things about due diligence is the buyer is the one who initiates due diligence usually and asks all the questions in the sale process. But sellers sometimes don't realise what they're getting involved with and don't do their own due diligence. So if you're going to buy a business, you're very well aware of buyer beware. So as a buyer, you're going to ask a lot of questions to make sure you're buying what you think you're buying. But a seller, there's not too many sales these days where someone says to you, here you go, here's your $8 million, see you later. You ride off into the sunset and you don't have any more worries. Usually what happens and this is related to live case studies I'm involved in, is they will usually come to you and they will lock you in, right? The reason why they want to buy your business is because you've got a successful business, and usually it's got something to do with you and your involvement and some key staff being involved. Whether they keep you as key staff forever or whether they just want to learn off you, they're not often going to let you go too quickly. So this example, you sell you sell your business for $8 million, and then on the initial date, just say, all right, on 30th of June 17, we're going to give you, of that $8 million we're going to buy the business off, we're going to give you $3 million in cash, $1 million in shares in our business, and then in 2 years' time, if you make a certain profit within your business, we're going to give you $1 million in cash again and $1 million in shares. And then the year after that, we'll give you $1 million in shares and $1 million in cash. That's often how it works. And the reason is they want to lock you in. And that means you need to understand their business nearly as well as they understand your business. Because one thing is they're going to lock you in for an employment contract, golden handcuffs, whatever you want to call them, and that will be a couple of years. So you're going to have to be employed by people. So you might have been used to running your business, doing what you want, then all of a sudden someone else is your boss. And you can contract that out very well and kind of think that you're going to be autonomous, but you need to be very careful with the details and make sure your legal team is looking at the employment contract to make sure you do have autonomy. And so that's the employment side of what you'll be doing. And then there's the ability to make the profits, the earn-out, as they would say, right? So you've got to make a certain profit. You've got to make, $1 million profit in the first year after you're bought. And then you've got to make $2 million in profit the next year. So if you don't have the autonomy to run your business like you used to. You might be confident that you can make $1 million in profit in the first year after sale, and the second year, and the $2 million the next year. But if they restrict how you run it, you're going to be held up. You're not going to be free and able to run it the way you want to run it, which is going to restrict your ability to make the $2 million earnouts in the preceding years. And the other thing is, in that example I'm just talking about, the first $4 million, $1 million of that is in shares in their business. The next one, $1 million out of the two, is shares in their business. And the same for the last hurdle, the last performance hurdle or profit hurdle 2 years out. So you're going to end up with $3 million shares in their business. And that $3 million shares in their business, you won't be able to sell that straight away either. Depending if it's listed, and when it's listed, definitely won't be able to sell it straight away. You'll have to hold on to it for a while. There'll be an escrow period. And so once again, you're going to end up with shares in a business. If you don't do your due diligence, you're not going to know what those shares mean. So they might tell you it's worth $1 million, and if it is a listed business, the market will say it's worth $1 million. But if it's not a listed business, we don't know. And even if it is a listed business, I'm sure we're all aware of the share volatility, and that prices of shares can go up and down, and sometimes there's not a lot of rhyme or reason to it. And so you need to understand their business and be aware. Like in my situation, my client was just happy to get his $3 million. He just wanted the cash, right? So he's been I don't care about their shares. So if it does happen, you'll be happy because he's going to get a bonus by getting extra shares that are worth something in the long run.